You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp, the program for you, the basic retail stock trader. Maybe you're thinking about dipping your toes into those options waters. Maybe you've done so a little bit. Maybe it worked out well. Maybe you got burned. Either way, you want to advance a little more in your options trading and your options trading knowledge. Well, we got you covered. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from this fine network upon which so many of you are enjoying this show. If you like what you hear, make sure you keep those reviews coming on your platform of choice so new people can continue to discover this program during these trying times. You love to see so many new ear holes joining us on the show every week, and we love to see more. So keep those reviews coming, and of course, keep those questions coming. We do love to hear from you guys. In fact, you're making up the entirety of this program here this week, so keep those questions coming. A little behind-the-scenes spoiler for you guys. If you don't like waiting a week between episodes of Options Bootcamp, you want to hear them both back-to-back, you can join us live when we record these bad boys on the old Mixler link. You get both shows back-to-back. You don't have to wait a full week, so a little bit of a behind-the-scenes spoiler. Otherwise, you got to wait a week here. And I'm usually joined on this episode by my black-hatted compatriot, Mr. Passarelli, over there from Market Taker Mentoring. But he's on vacation this week. Joining us in the co-host hot seat out here this week, our old friend, the once and future Dr. Vix, a.k.a. Mr. Russell RHOADS. He's the options author extraordinaire, as well as, of course, teaching a few classes over there at Loyola these days and hanging a hat every now and then over there at EQ Derivatives as well. Mr. RHOADS, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
I want you to introduce me sometime as the man who never takes vacation.
Then what I call myself, because I'm always here, dude. I'm always here cranking out the shows.
Yeah, you're always there. You take a week once a year.
Yeah, you're right. Usually I do, but this year not so much.
maybe I could be, who used to sub for Johnny Carson all the time?
Wasn't it Joan Rivers?
Yeah, I'll be your Joan Rivers.
There you go. You can be my Joan Rivers. I could use a Joan Rivers every now and then.
I'll be your Joan Rivers the next time you want to take a week. I'd get a kick out of that.
Mr. RHOADS. So. Mr. RHOADS volunteering for the big chair. I kind of like it. As it's time to answer your questions, it is time for your mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, ever so festive as usual. Let's kick it off in the mail call. As we like to do, these are trying times for everyone. Let's kick it off, a little bit of fun, a little bit of love. This one comes in the form of a 5-star review from iTunes from Jingjang16. They say, waiting on Wednesday, they called their review. They say, absolutely love the show! Exclamation point. Well, we love you back there, Jingjang. The content is thoughtful and presented well. Mark Longo has a way of making very complex material easier to digest and keeps it fun. I listen to the other Options Insider podcasts as well, but OBC is more suited to my current knowledge level, which he puts in parentheses is low. So I find myself waiting for Wednesday to come around and for some fresh content. I know it must become mentally taxing to cover the basics over and over, but please keep it coming. Grazie mille. Well, I wasn't expecting a little Italian from Xinjiang over there, but thank you nonetheless, Xinjiang. We love you guys. All of you take the time to listen and then to read and to review the show and your platform of choice. We love all of you. That's how the word keeps spreading about this show out there. And we don't find it taxing covering this content at all. We do it because we love, because we care over there. Xinjiang and everyone else out there. Grazie mille to you back over there. All my Italians floating around out there in the ether. I love it. All right, next up, Mr. Rhodes, kind of a bit of a timely one. This comes from Brooke Livin. They want to know, what hedging strategies do you recommend now that the NASDAQ is back at all-time highs? You know, NASDAQ has been one of the first of the major indices to kind of shake off this pandemic yoke and say, you know what? I don't care about any of this. I'm off to new all-time highs. The last few months are just in the rearview mirror for me. We're shooting straight ahead and still threatening, I believe, is at all-time highs again as we're speaking right now. So interesting times we find ourselves in. Obviously, given these, shall we say, lofty valuation levels, the question is starting to come in hot and heavy about hedging. So, Mr. Rhodes, do you have a preferred methodology? I mean, they ask about NASDAQ, but we can broaden it a little bit if you want to go SPY or single names, whatever is floating your boat out there right now. What are you looking at right now in terms of effective hedging? Because obviously it's going out and just buying your 5% out of the money put. A little bit pricey right now, sir.
They are a little bit pricey right now, and one of the things they taught me when I started working at the Options Institute was when you're thinking about something and the option's expensive, look at selling an option as well. And there are two alternatives there, and there's actually three. But I'm gonna keep it at two here. If you don't like the cost of, and let's just stick with the 5% out of the money because you threw it out there. If you don't like the cost of buying a 5% out of the money put option on NDX or whatever because of the elevated implied volatility, all of these volatility indexes are elevated right now, which means on a dollar basis, justified or not, this protection looks more expensive than it normally does. You can do one of two things. You can, if you really think we've topped out, you might want to give some consideration to selling an out-of-the-money call or even an at-the-money call. And trying to cover the cost of that protection. The second one that I like an awful lot, and this is just because the skew of options, the put option implied volatility, the farther out of the money you go, especially for index options, the higher that implied volatility is. So maybe you buy a 5% out of the money option contract and you sell a 10% out of the money put option. That way you're getting protection for 5% of the drop, and it's not costing you nearly as much as as it would if you just bought that option outright. So and then you can combine both. I can't help myself here. You could always sell a call and sell the put. And not get full downside protection, but also maybe even reduce the cost to where all you're doing is giving up some opportunity cost to the upside. And not being protected for more than maybe 5% of a 10% drop to the downside.
Yeah, there's a lot of love for that collar with the put kicker over there. So the short put and the short call against the put against your portfolio, which of course is a collar plus out there, listeners. So you have seen more interest, Mr. Rhodes, coming in these days about effectively doing a little bit of a stock substitution, if you will, though not quite as aggressive. In this case, maybe just liquidating most or all of your holdings and then going out. Maybe you want to keep a little bit of that party alive in your index or single name of choice. So you buy maybe a near out of the money call. Maybe you buy more of a vertical to mitigate your outlay, and you keep the rest of your holdings in cash because maybe you're sitting on a lot of profits. You don't want to lose them, or you're just super skittish right now, and who could really blame you? Have you heard a lot of interest in that scenario out there as well, Mr. Rhodes?
Not as much. I think a lot of people have missed this move already. So, I think a lot of people panicked back in the March, April timeframe. We saw it in the market activity. So I'm not sure, and maybe the reason that I haven't heard your idea, which I think is a great idea, is because you don't have a whole lot of people that have decent profits at this moment and are trying to lock them in.
That could certainly be. But if you're sitting on some, maybe it's one to consider. I had someone on the network not too long ago effectively promoting what he termed a black swan fund, and all it was mostly cash and a little bit of upside calls. And that's what they term a black swan fund out there these days. So interesting how people view the lens of hedging out there right now. We could talk about this for the rest of the show. We got to move on to some other questions. Next up, Theodore Domzowski. This name sounds familiar. I believe he wrote in before. Yes, he does. He says, thanks for the mention this week, and thanks for the advice. New question for this newbie to the Sith Lord and the Jedi Master. I do believe Mr. Passarelli is the Sith Lord out there, even though I do like to lean to the dark side myself, even though I tease Mr. Passarelli about that. He wants to know, how do you forecast the market direction? Do you use technical analysis or fundamental analysis? I started by using news. The news would look awful, and then I would put a position on. Next thing you know, the news gets worse, but my forecast would still be wrong. This might be a topic for a different show. I love this addendum at the end. I love our audience. He says, also, check out these burgers. He sent a photo of him apparently grilling what looks like some pretty delicious burgers. I do have to say there, Theodore, I might skip to the ones that without the cheese looks good. It's a lot of cheese, though, and I'm lactose intolerant, so I might go for the non-cheese burgers. But thumbs up on the burgers. They look pretty good. Looks like you're a charcoal man, maybe, so a little bit of old-school grilling for you. So thumbs up on the burgers. I don't know. Are we talking about burgers on the show? I don't remember it. But either way, we welcome your food-related pictures. Why not? And then he wants to know how we analyze. I've come out on this network many times and said I'm not the biggest fan of technical analysis. I know there are others who take the other side of that. I think if Mr. P were here, he probably would as well. He's become a little bit more of a supporter, I think, out there of late of technical analysis. But for me, I've never really found it to be very effective for my use case. I'm much more of a fundamental analysis kind of guy, and using that to kind of analyze positions and that sort of thing. Also, I like to look at the options flow, and I guess if you can call that technical analysis, look at the skews and the setups and do my trading there, because I don't trade a lot of underlying. I mostly trade the options. So I look for where the favorable setups are from an overall volatility and a skew perspective, and I allow that to dictate my trading out there. So a little bit of a different viewpoint than I think you're looking at here from a pure underlying perspective. Mr. Rhodes, do you have a way you like to lean one way or the other? He likes to put in a stark contrast of technical or fundamental analysis, sir?
I'm still trying to figure out who from Star Wars I would be.
You might be Admiral Akbar. It's a trap. It's a trap. That's you.
Okay. Oh, I thought it was. I'm either one of the X-wing guys that gets blowed up before they blow up the Death Star.
Maybe we can go with an Ewok. Maybe an Ewok might be suitable for you.
I would. You know what? This much quarantine and all the food I've been eating, I do look like an Ewok at this point, unshaven and round. So as far as technical analysis goes, I use one thing, and basically it's where we are relative to the 20-day moving average. All the option trades I do, I never have one that expires in more than a couple of weeks out. Like right now, I might be looking at next Friday's options to do something. I just found different strategies work better in a short-term uptrend versus a short-term downtrend. Most of the things that I do are really not directional, more what are the options pricing in relative to what kind of price moves am I expecting, or what kind of price moves have we gotten in whatever current environment we're in relative to what the options are expecting.
Yeah, that's why it's kind of hard for us to answer a question like this, because we don't really, a lot of people come in, they want this straight up, hey, how do you analyze the underlying and then set up your options that way? And it's not really the approach that we're taking. Not all the time, at least. Sometimes it could be. And I'll get Dan on to answer this question next week. What was the name? Theodore. Maybe he has a different viewpoint on all things technicals. I think he likes to use technicals around earnings. Maybe we can talk about that a little bit. Let's see here. Got to keep rolling, though, here. This comes from Melon. Melon says, Options Oot. I think he meant Options Boot Camp. Options Oot Camp is my favorite podcast. Well, thank you, Melon. Thank you for producing this fine program. Well, you're welcome. Thank you for making it weekly. Now, next step, daily. Yeah, there probably is enough demand to do it daily. Whether we have the time and the wherewithal to do it daily, I don't know. Just getting everyone's schedules aligned on a weekly basis is a bit of a challenge. That's why we do the 2 shows back to back now. Makes it a little bit easier. But there certainly is demand for it. So maybe you guys want to see an Options Bootcamp daily? Hit us up. Let us, maybe if there's enough demand, we can explore that. All right, next up. There's another name that sounds familiar here. Christopher Lovell. This is an epic treatise. So I'll try to summarize it for you. He says, whoa, Burrow. I'm not sure. Burrow. donkey? I don't know. He says, I got a shout out on my favorite podcast, and Mark Longo pronounced my name correctly. Well, Lovell, is that a hard one? Really? Maybe. He says, smiling face with heart-shaped eyes. Well, I'm glad I could make your day there, Christopher. He said, I knew I had to get in an actual trade. Oh, that's right. He wrote in because he had made his first ever options trade, and he bought a put on GE. That's right. We talked about this on a recent show. He says he gives us some reasons why he bought a put on GE, and we want to know how it turned out. He says it worked out, and it was profitable multiple times, but it sounds like he made a very common mistake when buying options, which is not taking it off at a favorable time. He says, it's too bad I didn't have a real exit plan in place prior to getting the trade in. Despite reading about that and hearing you guys talk about that many times on the show, I needed to put my hands on it to really get my head around how important that is. And so it sounds like at the end of the day, it went back against him, and he lost $12.91. He said, $13 premium I paid for a lot of education. Well, that's a good way to view it, $13 in the grand scheme. Not much, and it sounds like you learned a lot there. What was it, Chris? So he wants to know, with all the moving parts in an options trade, how do you monitor it daily? I have a hard time visualizing all the moving parts and keeping up with it. It's not quite as easy as trading intraday off of a candlestick. Much love from Alabama. You guys rock. That's a good question. I think a lot of people, we mentioned this earlier on some of our other shows, even today, about how much of the action takes place in the equity options in the weeklies, in the short duration. So monitoring them intraday is much more important than even it was a few years back, when most people would put on maybe monthlies, maybe a little bit farther out, and kind of set it and forget it for a little bit, and you check in on it every now and then. If you're trading near duration stuff, and it sounds like you were here, Chris, then you really do need to monitor it. So first off, find a good broker that can really give you the good tools to monitor your positions, of course, the Greeks, your risk, what the current market is to close all that out. Hopefully some of you skew in analytics. Maybe do a little bit of back testing on your position so you can see how it performs in different scenarios. And also, it takes a lot of time as you're kind of learning here. You have to be able to monitor this stuff. So that's why it's challenging people with a day job to be slinging the weeklies day in and day out, because you can't really monitor, particularly a trade like this, when it sounds like you would have helped yourself by having that plan at the outset to put in a price you would be willing to sell it at. You learned that lesson now, so that's a good thing. $13 well spent in that case. So you can work some of those limits. That could take some of the effort out of your hands. But still, you're right. It is a challenging thing. Mr. Rhodes, do you have any suggestions here for Chris about how to visualize all of the moving parts and keep up with his portfolio intraday, sir?
Yes. Focus on the underlying. The reason that he got into the trade was the underlying, and he should have a price target where he thinks that he wants to get out of his trade. And this was a pretty cheap option, so using some sort of stop didn't make a lot of sense. But if there were more dollars involved in it, I think he mentioned that he felt like GE was in a downtrend because the 10-day had crossed under the 50-day. Well, maybe if the 10-day crosses back above the 50-day, you get what you can for the option. But I always feel like, especially just buying a put in a directional trade like that whatever decisions you make about what you're going to do with the option should really start with what was your forecast for the stock, and is it playing out or not?
Yeah, you got to have that plan at the outset, and that's why we always say, particularly in the long premium, that option is dying a little bit every day, so the clock is ticking every day. And so if you have a nice move early on in an options life, I get it. It's kind of like you go to Vegas for a week or something and you win big on your first hand at the blackjack table on your first day. You're like, I don't want to take my winnings and go, even though that's the smart choice. That's kind of sounds like what you needed to do here. And that can be hard for some people. They don't want to take it all off. So maybe you take a portion of it off. That's why also you need to establish that plan at the outset. Hey, if it goes up this much, I'm going to close out all of it or perhaps part of it. And that way it makes your job a little bit easier, because when it's all happening, you're right, it's a little bit crazy. It's a little bit hectic. It's hard to make decisions in that environment. So if you plan that a little bit ahead of time, then that will make your life much easier. So much love back at you over there. What was it? Chris from Alabama. Next up, Ghosts. Ghosts 4. Ghost 4 says, why are there so many options exchanges? Does this have any unanticipated impacts for options traders? Thanks. Well, so many options exchanges. Well, we can talk about that for a while. Seems like the flow of options exchanges has mitigated. I believe we're topped out around, 16 or so now. And then most of these, when you say exchanges, you have to kind of look into what that means. Like NASDAQ, for example, who are our former partners on this program for some time, they have about 6 exchanges under that NASDAQ umbrella. There's the core NASDAQ options market, the NOM, there's the Philly. They bought ISE, so there's ISE and Gemini. There's a couple others floating around in there as well. So, yeah, there are separate exchange licenses, but they all really are under the umbrella of NASDAQ. And what an exchange has kind of become in that scenario is different fee models. One's a maker-taker, one's a taker-maker, and they charge different rebates and give different rebates to incentivize different types of trading activity, really. So the notion that they're separate entities is really kind of different. Now, obviously, a different exchange group, like a CBOE versus the NASDAQ, they're a little bit different, and they can also have their own proprietary products. If you want to trade VIX or SPX, you can only go to CBOE. So that makes it a little bit different. But for most of you out there, unless you're slinging large institutional size out there, it doesn't really have a huge impact. I will give you, except for this one caveat where we see people start to encounter, is you listen to a show like this, or you do some other options education out there, you get a little bit more sophisticated, and you start going from single leg options trades into spreads. That's where we start seeing people have some issues with this, because all these different exchange entities, they have their own spread books as well. And your order is going to get routed to one of those based on a number of factors, the payment for order flow to your broker, all these other things. And where your order gets routed to and where it's actually bid away could be two separate things, and they don't really talk to each other. You're not going to get that same bit of making your order good, honoring away markets that you get in the single order area. So where you start doing spreads, sometimes you see the fills, wait a minute, I'm bid away, how come this isn't getting filled? And you have to contact your broker, and let's say you have to move it to a different exchange to get it filled. So when you start trading spreads more actively and for decent size, I'd say that's the one area where the unanticipated consequences start to rear their ugly heads. Mr. Rhodes, would you concur with that? Or maybe you have some alternatives for where you think people have unanticipated impacts, as he terms it, for options traders, sir, of many exchanges.
No, it's what you said. It doesn't, I think for the small trader, it really doesn't make that much of a difference where things get executed. Your broker is supposed to send you're supposed to send your trade to wherever the best execution will be. And in fact, you can call them up and say, I want to see an audit of all the trades I gave you and where did they get sent, which hopefully everybody doesn't do that to their broker at once because it would overwhelm them. And then just to answer his first question there was, why are there so many option exchanges? Well, I'm a professor at Loyola, and I teach a lot of different classes, but they're all finance. And I tell my students when something doesn't make 100% sense, there's one word to answer it, and it is regulatory. And it really is because each exchange can only offer this one fee structure across the board to everybody that sends an order to them. So if you want to have a slightly different fee structure, you basically have to open another exchange.
Yeah, that's why most of these exchanges out there are really just different fee structures, like we were saying earlier, and that is a result of our regulatory environment here. I've talked to this exchange many times about this. They would love to have the ability to maybe offer different fee schedules within the same entity, but they can't. They're not allowed to charge one price for Apple to one person and a different price for Apple to another person, hence where we find ourselves today out there. Good question there, Ghosts 4, and maybe probably sinking our teeth into that more on a future episode as well. But I want to get more of your questions on here. Oliver is next. Oliver C. Can you please do an episode on second order Greeks? Well, first off, Oliver, I'm going to make you happy. This is a standard caveat I put out there to everyone who sends in a question. Check our archives, because the chances are we've discussed that already. And in this case, we have. It was Options Bootcamp 59. This says it was 5 years. I can't believe it was 5 years ago we talked about that. But we had an episode 59. It was called Going to the Dark Side with Second Order Greeks. So I encourage you, Oliver, and everyone else out there to check out that episode. But, maybe your question might be an indication that maybe it is time to revisit that subject. It's certainly a less heralded aspect of the Greeks. Dan and others have written many books about the basic Greeks, your Delta, Gamma, Theta, and Vega, and sometimes Rho thrown in there as well. But once you start getting beyond that into the Greeks that measure your skew risk and everything else like that, it's not really a big part of the conversation that often. So it might be, Oliver, maybe it's a time to revisit that subject. Maybe on a future episode of Options Bootcamp, perhaps we'll sink our teeth into second-order Greeks. Mr. Rhodes, what are your thoughts here for Oliver C. on second-order Greeks and perhaps their utility in your view, sir?
I think that is something that is best looked at when Dan is back from vacation, because he really is, people will say, I wrote the book on VIX. He wrote the book on the option Greeks. He's written a couple of them on the option Greeks. So he's the best person to talk about that, and you're lucky to have him on this show.
I say that every day to myself. I'm so lucky to have.
You're so lucky to have him.
Don't let him hear you say that. So we'll get an even bigger head. He won't fit in his hat anymore, sir, which will be a shame for all of us here on the show. All right, next up, Jeffrey. Jeffrey, here's a good one for you, Mr. Rhodes. What do you think it would take to get VIX back down to its 2017 lows again? Of course, 2017 was that very, very rare year that bucked everyone's expectations. I don't think there was a single person on this network, myself included, who predicted coming into the first year of the Trump administration that we would have less volatility. Everyone said there's one thing you can count on with Trump, that he's not a single-digit VIX president. That quote was actually made here on this network, and it turned out he was exactly that. For pretty much the entirety of his first year in office, VIX was about as anemic as I've seen it in quite some time. And that had all sorts of ancillary impacts on the market and the space. Options volume kind of dwindled. It was a very interesting, kind of stagnant time for the options market. So interesting thought question, Mr. Rhodes. Jeffrey wants to know, what do you think it would take to get us back down to those, a good 9 handle in the VIX again, sir?
Well, the first thing that pops in my mind is a lot of time. I'm thinking, we had 2008, 9 years later, 2017, we're down to those levels. So let's say 2029. But then I started thinking things through, because I've been watching it, how quickly VIX has come back down in this current environment. And basically, ever since we topped out in March over 80, the amount of time that it took for VIX to fall below 50, below 40, below 30, below 25 was about 1/3 the amount of days that it took after 2008. So I wonder if 3 years from now we might not be back down to those same levels, especially if you have such an accommodative Fed that's trying to do nothing but squash volatility. So it may happen quicker than you know it.
I was going to say 2029. Wow, that's a long time horizon.
Yeah. Well, the pattern is 2029, because it was 2008, really high, 2017, really low, and then we worked our way back up in 2020 to a big high. So that's 9 years, 2029. There you go. June 3rd, 2029.
Yes, there you go. You've heard
Write it down.
You've heard it exactly here. June 3rd, 2029 was the name. Jeffrey. That's exactly the day we'll be back in that single-digit handle out there for all things VIX. Come up against it here, Mr. Rhodes. Let's see if we can get a quick one in under the wire. Let's end with some fun as well. I always like to end with some fun. This one comes from M-Tech. M-Tech says, got some interesting comments here this week. We love you all out there, listeners. He says, in the spirit of The Last Dance, Longo is definitely the Michael Jordan of options podcasting. Long may he stay on the air. Thanks for so many great shows. Well, thanks back at you, M-Tech, and everyone who took the time to write into the show today, to send in your questions, of course, to leave your reviews on your platforms of choice. Those are always important, particularly in this environment out here, to keep new folks discovering not just this show, but all the content that we do, and I do appreciate the love you guys have sent our way. It's right back at you. We love all of you. That's the reason we keep doing these shows. If you need more education, coming back at you in a little bit here on the network, we'll have Options Playbook Radio. Unfortunately, that one won't be live. It'll be live on your podcast device not too long from now. So you have a whole bunch of new education. Brian and his crew will be diving in there to talk all things options in a little bit as well. But unfortunately, Mr. Rhodes, that music means we have come to the end of this fun program. Man, it's amazing how quickly time flies when we're talking some options boot camp, sir. But Mr. Rhodes, if folks are intrigued, if they want to check out some of your previous books while they're waiting for the new book to land, or maybe you got some interesting articles out there you want folks to check out, where should they go? What should they do, sir?
I'm at eqderivatives.com. Most of what I write does not show up behind the paywall, and I can't help myself. Yes, Longo is the Michael Jordan. If you've seen how Jordan acts in practice, that's Longo during rehearsals.
Yes. I'm a jerk. I get in your face. I punch you. I tease you mercilessly during the training. Yes, you don't see all the behind the scenes. This mask, this facade of niceness on the air, it belies the beast within. Thanks for that, Mr. Rowe. Thanks for the question, M-Tech, and everyone else who wrote in out there, sending your pictures of your burgers and all the other fun stuff that you do. We love to hear from all of you. Keep the questions, keep those comments coming, and we'll see you back here next time for more Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.